Warren Buffett is known to be one of the greatest investors ever. He came from modest beginnings to build his wealth. Imagine a fortune of over $107.6 billion. There is no better way than Warren Buffett's investment strategies. In this video, we will be looking at the 6 investment strategies of Warren Buffett. But before we begin, make sure you like this video and hit the subscribe icon. Why should you follow his strategies? We can rightly say that his vast wealth is built primarily on the stock market, making him one of the most successful investors. Warren Buffett isn't the only investor we have, but his tips, manner, and rules of investing make him different from the majority. So following his lead in terms of investment psychology and strategies will serve you well in your activities in the stock market. Warren Buffett's 6 key investment strategies. 1. Never lose money. This is the first and most important investment strategy for Warren Buffett. This strategy has less to do with market fluctuations and more with an investor's temperament. This doesn't mean you can't go through any loss, but what he means is that you should live frugally. This means you should be extremely conscious of your spending and focus on a few financial priorities. To achieve this, you should consider your main goals and how changing your finances can help them reach them. Buffett lives in the same house he has since 1958 and never fails to pick up McDonald's for breakfast. So his habits should be a lesson for those looking to invest like him and those who run their own business. So like Warren Buffett, we need to be careful with how we spend our money if we want to get rich and stay that way. 2. Know what you're investing in. Another investment rule of Warren Buffett is not to invest in a business you do not understand. The first thing to do may be simple, but it's vital. Buffett doesn't make a blind investment no matter how it is hyped on social networks or in the media. Every investment he does make is always highly calculated and in his areas of interest. So if you're planning to invest just like Buffett, you should invest in industries that interest you and know intimately. Don't just invest just because others are investing. Investing is a process that takes quite a bit of research. If you're not interested in whatever you're researching, it is not advisable to do exhaustive research. On the other hand, if you have an intimate understanding of the industry you're willing to invest in, you know exactly what to look for regarding the factors that drive success within the company's industry. Another strategy related to this is always to fit an investment into specific criteria. This is one thing Buffett does while investing. Even if he believes that a company he's looking to invest in will succeed, he does not risk his money or assets on anything that doesn't fit specific criteria. To buttress this fact, Warren Buffett has these criteria he uses when determining whether to invest in a company. A stock must be sensibly priced. As an investor, the first point of interest should be the stock's value. You can use various valuation metrics to ensure you're getting a good deal before investing. Management must be quality. Before you invest in any company, you should understand who's running it. The company must be aggressive with its reinvestments because the capital will be a far more lucrative endeavor. The company must have strong earnings power and be generating compelling profits. 3. Get into healthy financial habits. In a college speech, Buffett said, "Most behavior is habitual, and the chains of habit are too light to be felt until they are too heavy to be broken." He pointed out that among the most important habits, the major one to be formed is how to save money. The biggest mistake you can ever make is not learning the habit of saving properly. That's why he suggests setting automatic reductions in paychecks. It is also helpful if one transfers money into savings or investments to help make this habit regular. He said, "Do not save what is left after spending. Instead, spend what is left after saving." 4. Cash is an investment. As an investor, you must maintain a fair amount of cash or its equivalent. You should always be ready to be drawn throughout staggering times. We understand that Warren Buffett is a strong proponent of taking advantage of opportunities in the stock market. Still, if he has an opportunity that fits his criteria, he will always be ready to hold his cash. The value of cash has grown faster than the value of stocks numerous times. So having liquid cash in your pocket makes you take advantage of strong opportunities in the stock market as they arise. You don't have to settle for a stock that simply won't produce the returns you're envisioning. As such, be highly selective in the investments you make. If you can't find a stock that fits your investing strategy, you can always hold your cash. More opportunities will surely arise soon. 5. Invest in yourself. It has always been Buffett's saying that you should always invest in yourself as much as you possibly can. No matter what it is, you shouldn't just be idle. He said anything you do to improve your talents and make yourself more valuable will get paid off in terms of appropriate, real purchasing power. When you invest in yourself, the return will always be favorable for you. Unlike assets, one's skills can't be wasted or lost. What you have in you cannot be taken from you. That's the code of investing in oneself. From going to school and improving your knowledge to overseeing training or taking a volunteer post, all these investments will certainly improve one's chance of becoming wealthier. The more skills you develop, the wealthier you'll be. It's as simple as that. Buffett also emphasizes that being a business owner can be highly profitable. As larger companies lay off their employees, business owners who provide services to self-employed self-starters can find opportunities during difficult economic times. The recession fueled the demand for most business formation and compliance filing services. So you need to have the courage to take risks and start your own business, as it is always part of the dream. Generally speaking, people see a job as a safe and secure option, and that business may scare many people because of the tasks involved in just getting started and even the risks it takes. However, if you don't start, you won't get there. Despite the high financial risk, it is always rewarding to run your own business because it gives you a higher chance to make more money even when the economy isn't doing well. As a business owner, you'll be your own boss and you can't get fired, unlike when you're employed by someone else. You will also be free to make decisions crucial to your business success and benefit from your hard work. 6. Set long-term goals. This is another rule you should always yield to. Buffett said the most common mistake people always make is attempting to seize any rising price wave for instant returns. Setting long-term goals is a viable solution to achieving challenging endeavors. Long-term objectives require extensive preparation to ensure you can accurately complete them and by the timeline set. You should learn how to create and follow through with your goals, as it will help you better focus your efforts on accomplishing them. You shouldn't invest all because you want to see an instant gain. Buffett also said investing with a multi-decade horizon rather than seeking quick earnings is best. That's the joy of investment, and it will surely yield. And that's all for today, guys. If you enjoyed this video, ensure you subscribe to this channel and give this video a like. Thanks for watching. See you in the next video.